A Sumerian merchant stands in a marketplace around 3500 BCE, holding two clay tokens in his palm, one shaped like a cone for grain, one carved like a sphere for oil. He has never heard the word currency, yet what he's holding is the ancestor of every financial system that will follow. The tokens are weight matched to what they represent. The ratio between them is stable. They can be traded, stored, compared, exchanged. He understands intuitively what a modern economist needs a PhD to articulate. Value is relative. Exchange requires trust in a shared standard. And information about abundance or scarcity travels through the market as price. His brain, shaped by 200,000 years of small group economics, recognizes the mechanism instantly. He doesn't overthink it. He acts. Move forward 5,000 years. A modern investor sits at a desk, screen glow washing his face blue-white, staring at a portfolio dashboard. The numbers flicker. Green, red. A percentage he doesn't quite understand ticks upward and downward. His retirement account, something he will never touch, never hold, never fully comprehend, fluctuates by thousands of dollars per second based on algorithmic trades executed by machines he's never seen. Buying and selling securities backed by debts he couldn't trace if he tried. He feels anxious. He refreshes the screen. The anxiety deepens. He makes a decision based on that feeling, and it costs him money. His brain, the same brain that served the Sumerian merchant so well, has become a liability. The system hasn't trained his instincts. It has trained them into a corner. This is not a story about evolution failing us. It's a story about institutions succeeding beyond anyone's design. The invisible architecture was built slowly, deliberately, over centuries. It did not arrive as a conspiracy. It emerged as a solution to a problem. How do you scale trust? A small tribe needs no medium of exchange. Everyone knows everyone. Reputation is immediate. Transactions are face-to-face. Cheating is impossible without consequence. But empire requires distance. It requires strangers transacting with strangers, across continents and generations. It requires instruments that can move value without moving goods. It requires a system where you do not need to know the person you're trading with, you only need to trust the institution backing the transaction. This is when the system's relationship to your ancient instincts begins to fracture. For 200,000 years, humans operated under what evolutionary psychologists call the small-scale society default. Dunbar's number, the cognitive limit on the number of people with whom one can maintain stable relationships, hovers around 150. Most of human history occurred within this bandwidth. You knew your traders. You tracked their reputation across seasons. You could smell deception. A lender who systematically exploited borrowers would find no one willing to borrow from him by season's end. The system was self-correcting through the mechanism of reputation within a tight network. But scaling empire requires breaking that mechanism. You cannot maintain a stable reputation-based system across thousands or millions of people. The solution was institutionalization. Create a structure, a bank, a government, a corporation that stands between the individual actors and the transaction itself. Now the lender does not answer to borrowers he knows. He answers to shareholders. The trader does not answer to the people whose lives his trades affect. He answers to a compensation committee. The mechanism of direct accountability dissolves. In its place emerges the mechanism of abstraction. The system is so complex, so multi-layered, so mediated through institutional channels that no individual can be held responsible for any specific outcome. For much of human history, that institution was the crown or the state. A sovereign would stamp a coin with his face, and the metal's weight guaranteed the value. The genius of this system was that it externalized trust. You didn't trust the merchant. You trusted the king's ability to not debase the currency. This worked as long as the king had an incentive to keep his word. The moment that incentive vanished, the moment empires faced fiscal crisis, or the moment technology allowed currencies to be printed without metal backing, the entire system became an agreement among participants that this piece of paper or digital entry was worth something because everyone believed it was worth something. This is where the psychology diverges from the mechanism. Your ancient brain evolved in environments where value was tangible. Grain could be held. Oil could be smelled. Cattle could be seen grazing on the horizon. A claim on future grain was backed by the knowledge of next season's planting and the certainty of whether the rains would come. The entire system operated on what psychologists call high cognitive bandwidth. You could access most of the relevant information your decision-making required. The marketplace you could see. The harvests you could track. The credibility of the trader based on reputation within a network of perhaps 100 people. Modern finance operates on exactly the opposite principle. It is high abstraction, low bandwidth. The stock you buy is a claim on future earnings of a company whose operations you cannot observe. The bond is a claim on a government's tax revenue, filtered through institutional intermediaries you cannot audit. The derivative is a bet on a bet on a bet. So many layers removed from the underlying asset that tracing causality requires specialized training. And crucially, this is where the institutions win. The complexity is necessary to maintain control. Consider the documented behavior of investors across market cycles. A 2013 study by Vanguard analyzing client trading patterns during market volatility found that investors who interacted least frequently with their accounts receiving quarterly statements instead of real-time updates outperformed frequent traders by an average of 1.3% annually. The difference was not due to superior stock-picking ability. It was due to reduced decision-making. The traders were making the correct actions, buying low during panics, selling high during booms because their ancient instincts were intact. But the modern system had weaponized those same instincts against them by providing real-time information. Every refresh of the portfolio triggered a fight-or-flight response calibrated for immediate survival threats, not long-term wealth accumulation. This 1.3% may sound trivial. Over a lifetime of investing, it compounds to the difference between comfortable retirement and financial anxiety. But the mechanism matters more than the number. The information was not making investors smarter. It was making them more reactive. It was making them accessible to their own ancient programming in a context where that programming destroys value. Picture the moment of crisis. March 2020. The pandemic announcement. Traders across the world are watching markets plummet. The screen shows red. The amygdala fires. Cortisol spikes. Blood vessels constrict. The body prepares for flight. And then the person acts. They liquidate positions. Crystallize losses. Exactly at the moment when holding would have generated the highest returns within 6 months and substantially higher returns within a year. The instinct is perfect for escape from a burning building. It is catastrophic for capital preservation in an abstract financial system. The institutions do not prevent this. They facilitate it. They make real-time information instantly available. They make trading instantly executable. They profit from every trade you make in panic. And critically, they build the infrastructure in a way that removes any friction that might cause you to pause, reconsider, or ask yourself whether this action aligns with your stated long-term goals. This is the machinery. Not conscious conspiracy, but systemic design that benefits those who understand the system's abstraction while harming those whose instincts are calibrated for tangibility. Banks hold reserves. Institutions understand the difference between volatility and loss. Professionals manage the panic by not looking at the screen. Retail investors, people whose financial instincts evolved to serve them perfectly in a marketplace where they could see what they own destroy themselves through perfect execution of obsolete instructions. The second weapon is the illusion of control. A modern investor has access to more information about financial markets than any human in history. CNBC runs 24 hours per day. Financial data is freely available. Strategies are documented. And yet access to information correlates negatively with long-term returns. A 2015 analysis by Morningstar of 15-year portfolio performance found that the worst-performing investor group was those who monitored their holdings monthly. The best-performing group was those who checked their performance less than once per year. The investor who acts on the most information makes the worst decisions. Why? Because the information is designed to create the impression that your action matters. Market commentary presents every tick as news. Every quarterly earnings report is framed as either a victory or a disaster. Every Federal Reserve interest rate decision is declared epoch-shifting. The actual signal-to-noise ratio is perhaps 5% signal and 95% noise. But the noise is so professionally packaged, so immediately available, so presented with such authority that your brain treats it as signal. You feel competent when you are actually being managed. The institutions understand this. That is why every trading platform is designed with colored buttons, instant execution, and a constant stream of opportunities. That is why advisors are incentivized by trading volume rather than client returns. That is why passive index funds, the only investment category that consistently outperforms based on decades of data, are marketed with less intensity than actively managed funds. The system does not want you to understand that doing nothing is the rational choice. Doing nothing generates no fees. Doing nothing requires no advisors. Doing nothing means institutions cannot extract value from your decision-making. Pause. But the turn is sharper than this. The real destruction of ancient financial instincts was not technological. It was institutional. For millennia, there existed checks on pure financial abstraction. A merchant had to be part of his community. A moneylender operated in his own city. A landowner lived on his estate. The people who made financial decisions bore the consequences of those decisions. When a medieval noble overborrowed and the harvest failed, he personally faced starvation. When a banker's loan went bad, he was personally accountable to the lender and the borrower, both of whom he might see at church on Sunday. The financial system remained tethered to reality because the decision-makers lived in the same reality they were shaping. The institutional separation severed this connection. A trader at an investment bank in London makes decisions that devastate manufacturers in Michigan. The trader will never see them. The trader will never hear about them. The trader is evaluated on quarterly returns and will have moved to a different position before the consequences fully materialize. An executive at a pharmaceutical company raises prices on insulin by 1,200% over a decade, while shareholders celebrate the revenue growth. The executive will never meet the diabetic who rations insulin or the widow who cannot afford her late husband's medications. The system has created decision-making distance. This is the uncomfortable truth that polite conversation refuses to say. The destruction of ancient financial instincts was the goal, not the accident. It was not a side effect of complexity. It was the purpose of creating the complexity. Because ancient instincts, the instincts of the Sumerian merchant with his clay tokens, pointed towards systems where value was connected to utility, where abundance was visible, where deception was punishable, where long-term relationships mattered more than short-term extraction. Those instincts are death to a system designed around extraction. The modern financial system requires that you believe things that are not true, that you can benefit from everyone around you losing money, that the price of an asset has no connection to its fundamental utility, that leverage and abstraction create value rather than transfer it, that the person across from the trade is not really a person at all but a counterparty in a transaction that is properly evaluated only by its profitability. These beliefs contradict everything your ancient brain knows about how human exchange works. So the system does not ask you to believe them explicitly. It instead creates structures where you can act as though they are true without being forced to face the contradiction. A mutual fund manager does not think of herself as betting against families trying to afford homes. She thinks of herself as managing a portfolio. A hedge fund trader does not think of himself as extracting value from pension funds. He thinks of himself as alpha generation. A pharmaceutical executive does not think of herself as choosing profit over human lives. She thinks of herself as maximizing shareholder value. The abstraction creates a psychological buffer. The ancient instincts that would otherwise say this is wrong are rendered inert by the system's sophistication. What, then, is to be done? The answer is not to fight the system using the system's own language. You cannot beat a trading algorithm by trading faster. You cannot beat institutional finance by trying to be a better stock picker. You cannot beat abstraction by adding more layers of analysis. The entire game is designed for you to lose if you engage on those terms. The leverage lies in understanding that the system's sophistication is also its vulnerability. It requires your participation. It requires your decision-making. It requires your fear and greed to drive transactions. The moment you withdraw participation, you remove the primary tool the system uses against you. This is not about opting out entirely. The system's infrastructure is too embedded in modern life for that, but rather about reframing your relationship to the parts of it you can control. Real-time information is noise designed to trigger panic. You can recognize this and ignore it. The financial media profits from viewership. Viewership comes from anxiety. Therefore, the media will present information in ways that maximize anxiety. A market rising 3% is framed as will it continue. A market falling 3% is framed as how low will it go. The information itself is neutral. The framing is designed to activate your ancient threat detection systems. The moment you understand this design, you can observe the information without being controlled by it. Portfolio monitoring is the enemy of portfolio returns. You can remove yourself from the monitoring loop. Most financial platforms make this difficult. They are designed to encourage frequent checking, but the option still exists. Create an automated investment plan. Set it to execute on a schedule. Then do not look. If you must check, commit to checking only quarterly or annually. You will perform better. Your peace of mind will improve. Your sense of agency will strengthen because it will be based on actual decisions you make rather than reactions to noise. Complexity is opacity. Institutions benefit from your inability to understand what you own. You can insist on simplicity. Own index funds instead of managed funds. Own shares of companies whose businesses you understand instead of derivatives on indices of indices. Own land or physical assets whose value you can touch. Same. And independently verify. This does not require you to become an expert. It requires you to have the discipline to say, I do not understand this, so I will not own it, and then actually refuse. Most investors cannot do this because they fear that refusal will cost them returns. But the data is clear. Simpler portfolios outperform complex ones. Understanding leverage is understanding how the system operates. Most of the system's power over you derives not from your ignorance, but from your participation in structures that profit from your specific type of participation. A hedge fund does not profit because its managers are smarter than you. It profits because it operates in a space where fees are hidden, where returns are measured against benchmarks that make mediocre performance look exceptional, where wealthy clients have less price sensitivity and more trust in institutional authority. The moment you stop participating in those structures, the moment you refuse to pay 2% fees plus 20% performance fees for returns you could get for 0.03% from an index fund, you have changed the game. The ancient instinct was not to hold forever or to never trade. It was to have skin in the game and to know what you owned. A Sumerian merchant understood the value of his tokens because he could see what they could purchase. A medieval farmer understood his land's value because he lived on it and saw its yields. That instinct is not dead. It simply requires you to rebuild the connection between your financial assets and their underlying reality. This means own things whose value you can independently verify. Avoid instruments so abstract that you cannot trace their origins or understand their risks. Build a financial life where you can explain every position, every holding, every claim on future value without resorting to institutional language or the passive voice of modern finance. When you can see what you own, when you can touch it or understand its function or trace the chain of custody back to something tangible, your ancient instincts become useful again. You make different decisions. You hold longer. You trade less. You feel more responsible for the consequences. And because you make different decisions, you perform better. The system cannot exploit what you understand. It can only exploit confusion. This is not about being rich. It is about being conscious. It is about rebuilding the decision-making loop that the system has worked for centuries to break. The ancient merchant could not afford to be passive. His survival depended on his judgment. The modern investor has been sold the narrative that his judgment is the problem, that he should delegate, pacifize, trust the system. That narrative serves the institutions perfectly. It allows them to extract fees from your fear. It allows them to profit from your inaction. It allows them to present their interests as aligned with yours when they are often diametrically opposed. But there is an escape hatch. It opens the moment you recognize that your instincts were not designed for this environment. They were designed for an environment where value was tangible and consequences were immediate. You cannot rewire those instincts, but you can choose which environments you participate in. You can build a financial life that honors rather than fights your ancient programming.